Welcome to the Stock Health series. In this series, we are going to look at certain parameters and get to the final health score of stock requested by you in the comments section. Today, we are going to look at ITC, which is requested by one of our wonderful subscriber. ITC has market cap above 5 lakh crore and stock price around 420. ITC has diversified itself in 5 major businesses. Projected compound annual growth rate of all these are as follows. Considering tobacco being the highest revenue generator for ITC, its overall estimated business CAGR comes around 7.5% annual growth, which generates a business model score of 7 out of 10. In case of liquidity, we are going to look at these 3 parameters. If we find any problem, in that case only we will investigate further, else we will conclude the score. Debt to equity is long-term plus short-term borrowing divided by equity, which in this case comes 0.00015, which is as good as 0. Debt to equity should be as low as possible, which is great in this case. As debt to equity is very close to 0, we need not calculate interest coverage as it will be way above 1, which is what we need, so we will skip and come to current ratio. Current ratio is current asset divided by current liability, also called short-term asset and short-term liability. In this case, current ratio is 2.99, which is also great as it is higher than 1. So we have liquidity score of perfect 5 out of 5. For activity score, let's look at the cash conversion cycle, which explains a lot about the cash and product management simultaneously. In cash cycle, cash goes out to supplier, who provides raw materials to the company. Raw materials are processed to final product, which sits on company's inventory. The product then is passed on to customer on credit or on an instant cash basis, which is then received back to company. Ideal days to complete this cycle is -30 to 180 days. You will get to know about this in a moment. Now cash conversion cycle is nothing but days of sales plus days of inventory minus days of payables. Days of sales is time required by customer to pay. Days of inventory is time taken by product while sitting on inventory, and days of payables is time taken by company to pay its supplier. Days of sales is receivables by revenue multiplied by 365 days. Days of inventory is inventory by cost of goods sold multiplied by 365. And days of payables is payables by purchases multiplied by 365. When we calculate this for ITC, we get final answer as 23, 240 and 70 days respectively. Ideal values are mentioned on right side. Inventory's best figure depends on industry and product. And for ITC, we have cash conversion cycle of 193 days, which is not the best but not worse too, so we have activity score of 5 out of 10. For profitability score, we will be looking at NPM, ROCE, and ROE to see the efficiency of the company to generate profits out of current available capital and assets. So net profit margin is final profit divided by revenue. In case of ITC, it is 46.38% this year. Return on capital employed is calculated by profit before interest and taxes divided by total assets minus short-term liability. For ITC, it is 36.41% this year. Return on equity is profit by equity, which is also known as shareholders' funds. For ITC, it is 49.63%. Considering the last 5-year trend for all of the above ratios, ITC gets a profitability score of 4 out of 5. When looking through corporate governance, an important point to notice is that ITC doesn't have any specific promoter. Company is professionally managed by dedicated teams. Even in case of no promoter, pledging of shares is an important aspect. Here we have no problems as no shares are pledged. So, in case of governance, ITC gets 8 out of possible 10. In statistics, a metric called standard deviation is used to figure out how stable or consistent the values are. Lower values of standard deviation symbolizes most stability. In this case, we will be running standard deviation on last 5 years data of NPM and ROCE, which come out 7 and 2.7 respectively. ROCE is quite stable than NPM. So, we reach its score of 3 out of 5. In miscellaneous score, we will be looking for other pros and cons of the company. In ITC's case, They have good dividend structure but have other income this year which can distort few of return ratios as well as valuation. Also their PB ratio is little high. So we have a miscellaneous score of 6 out of 10. ITC's revenue growth in terms of compound annual growth rate for the last 3, 5 and 7 years is consistent around 7 to 8%, which is quite good. The estimated growth for revenue for next 5 years is around 7.5%, which is pretty decent. So the growth score comes 11 out of possible 15. Price to sales is a good ratio to find cheaper stocks quickly. Generally cheaper stocks have PS lower than 5. It's calculated as market cap divided by revenue. In our case it is 6.9, which is quite high. Proper market value is calculated by justified earnings multiplied by adjusted PE. In ITC's case, justified earning is 19,926 crore, which is multiplied to the adjusted PE according to 7.5% growth, which is 26. So we get proper value as 518,076, which is quite closer to its actual value, which proves the stock is properly valued. By estimating future value using CAGR, NPM and PE, we get forecasted value of 7,55,000, which is approximately 45% possible returns in 5 years. Hence we reach its score of 18 out of possible 30 in valuation. So after evaluating all the points, final score for ITC is 67 out of possible 100. You can pause the video for summary. This video is only for educational purposes, not to be taken as an investment advice. Do your due diligence before taking any investment decisions. Leave a comment about stocks you would love to see video on next.